reporting quality. So at the very beginning of this video, I would like to tell you, you must differentiate between the quality of financial reporting and in earnings quality, because they are two very different things. However, you need to combine both of them to get high quality financial reports. So on the quality spectrum, which we will be seeing shortly, the highest level of quality of financial reports includes two separate things. One is the quality of the reporting itself, and two is the quality of the earnings, meaning are they high and also are they sustainable, right? So that's what we're going to be looking at. Then we will get into the details of why and when either the quality of the reporting goes down or the quality of the earning goes down if the management is doing aggressive accounting, right? So what is the context in which we need to evaluate all of this? What are the mechanisms that stop them from doing this, right? So how does the government step into all of this? How do they try to discipline the management so that they don't do aggressive accounting? And if they're still doing it, how do we as analysts detect that? What are the warning signs we should keep an eye out for, right? So this is what we're going to be discussing. As I told you, earnings quality is a different thing than reporting quality, right? So we will be talking about both earnings quality and reporting quality. And as far as reporting quality is concerned, I want to emphasize on something that we have discussed throughout our financial statement analysis learning modules from the very beginning, that what we want is reports that are relevant, complete, neutral, and free from error. This is what constitutes high quality financial reporting, that they are not giving you a misinformation. They're not inaccurate, they're not misleading, right? They're not giving you incomplete information. Assuming they're giving you complete information, but the information is that the company is not very profitable, well, that's not a reporting problem. It's an earnings problem. What we want is both to be very good, that the reporting should be truthful and the earnings should be high, and not just high in this current period, but they should be able to sustain that earning. And that would mean good quality financial reporting and sustainable and high earnings, right? So as far as the reporting is concerned, we want them to be relevant, complete, neutral, and free from error. These 4 points are very important, right? And given that the reporting quality is good, then of course we want the earning quality to be high and sustainable as well. And these two things put together give us the highest end of this quality spectrum. That number one, the reporting quality is good, right? Which means it is as per the standards. Now, why we have not written US over here? Because that depends whether you're following IFRS or US GAAP. Even IFRS is a standard, right? So that also is GAAP, but it's not US GAAP. So whatever is the standard that applies to you, are you following that standard or not? And even within that standard, you're not making any biased decisions. You're not trying to, misuse the space the law is giving you or the standards are giving you to your advantage. You're genuinely reporting an unbiased, decision useful, high quality financial reports. And then coming to the earnings quality, that the earnings are high. And why we are saying adequate returns? Because what does high earning mean? High earning means that whatever your providers of capital want from you as a return, and this is going to be something you will understand when you do other learning modules in equity and in fixed income and in corporate issuers, if you haven't done them already, that how do we get an understanding of what is the required return from a company by providers of equity and providers of debt, right? Is the company earning that much on the business that it is doing? So whatever assets is investing in, is it earning enough return to be able to pay the providers of capital? That is adequate return, which means is the earning high enough or not? And maybe it's high in this quarter or this year, but is it sustainable or not, right? So these two things, which is sustainable and adequate returns, is related to the earnings quality. Both of them together, which is high quality reporting and sustainable and high earnings, brings you to the top of this quality spectrum of financial reports. Now, what's going down? Okay, we are still having high quality reporting, but your earnings quality might be high today, but maybe it's not sustainable. So your earnings quality is coming into question, but at least you're truthful in your reports. So your earning quality is down. That's part of business. It happens, right? But now this is something which is not good at all, because you are now making biased choices. This is a choice to be biased in the space the reporting standards are giving, right? And this is, of course, going to give a signal that the management is trying to manage the books, or they are going for something called aggressive accounting. And we do not like that. We do not like that. Another sort of worse situation of this, one step further down, is that not only are their choices biased, but they are consciously trying to manipulate the earnings. Right? They might be trying to show the earnings higher than they are. And we will talk all about how that is possible, how that can be done, what are the things we need to watch out for. They might be trying to smooth the earnings as well, right? Just to show a smooth growth in earnings per share. So how are they trying to manage the earnings? What are the different possibilities? We will have a look at that. And then, of course, they might start doing things which are outside the standards. Now, within biased choices and within earnings management, we are still within the standards. Now we have actually started doing things which are outside the standards, but at least we are not reporting fake transactions. And then finally, the worst possible situation is outright fraud, where we start reporting fake transactions. So what's really going on over here? We are either doing aggressive accounting as management, right? Whereas we want to do unbiased accounting. Now, accounting standards want us to do conservative. Is that the best case scenario? The answer is no. What is required from us is neutral, right? So this is something you have to understand, that accounting standards are conservative in nature. Accounting standards are designed to be conservative in nature. We don't have to be conservative. What we have to stop is being aggressive. And between conservative and neutral is okay. Now let me try to explain to you why that is. See, as an investor, let's say you are an investor in this company, whether you're providing equity or debt, the point is, you would rather have a pleasant surprise in future years. So let's say you look at the current earning and it is providing you a 10% return and you're happy with that, right? Now, if this goes down in future years to 9, you would be sad. But if it goes up in future years to 11 or stays at 10, you would be happy. So even if we are neutral and we reported it as what the reality is expected to be, well, that's fine with you. Or even if we were conservative and the reality is better, that is still okay. But if the reality is worse off than what we reported, that is something that the investors are not going to be okay with. So conservative is what the accounting standards are trying to achieve. What is required is neutral. Anything between conservative and neutral is all right. But aggressive is what we don't want. Now, let me just explain what is this big bath restructuring and cookie jar reserves accounting. See, sometimes what happens, let's say I'm a company and I'm being bought out by another company, or maybe there's two companies that are merging together, or some big transaction is going on basically, which gives me an opportunity to move things around right now, right? I might have, let's say within my company, I might have some inventory on my books, right? I'll take the opportunity of the restructuring going on and write this inventory down. In future years, what will happen is that I will be able to sell it at a higher price. So let's say I bring this value down from 12 million to 10 million. But then in future years, I'm able to sell this for 14 million and record a very big profit on it. So I can put my hand in the cookie jar and take out extra 2 million from it because I had taken that hit before. And at the time of restructuring, not a lot of people are going to ask a lot of questions because, well, there's big restructuring going on, right? So at that time, I might create a space which will help me in future. So these type of situations can be there. What you really have to understand is why they are being done. What is the intent behind them, right? Is the intent to mislead people or not? If it is, then that means there is a non-compliant reporting going on, or at least there are biased choices being made, or earnings is being managed, so low quality financial reporting is going to be there. Which brings us to the context of understanding what is the context in which this is happening so we can assess the quality. Now there is a fraud triangle that we need to understand, in which there is a lack of control. So the control environment is very important, right? If there are weak controls, then only it is possible that they will be able to do such things. But of course, they must have certain motivations to do those things, right? And then they must be able to rationalize their activity to themselves, maybe to their family members, if their family members know what they are doing, because everybody has a conscience, right? So how are they going to look at themselves in the mirror? We're going to talk about rationalization last, and we're going to talk about the control mechanism and how the government also steps into this second. What I first want to talk about, why do these people want to do this type of activity? What are their motivations? So first of all, they might have some poor performance, right? Earnings might be low, and that's natural, right? It's part of business. That happens. But the point is, what do you do when that happens? Right? Are you going to try and hide it? Are you going to try and put the dirt under the carpet? Right? So that could be a motivation. Maybe there's too much pressure on you. There's certain expectations of earnings and you just feel pressured. It's very, very natural for this type of situation to happen, right? You might have a expectation that you're going to keep growing, right? So you want to keep showing that growth with respect to your prior results. And you might be looking to change jobs, or your salary might be partially fixed and partially linked to the earning of that year. So you might have variable compensation, or you might be looking to switch jobs and you want to show good performance at the new company you're joining, the performance of the past company, so that you can negotiate a better package. Sorry, all of these are motivations that lead to senior management, CFO, CEO to try and reduce the quality of your financial reports. So we understand the motivations, but more importantly, we have to understand the lack of controls, because if the controls are weak, only then are you going to have an opportunity to actually go about and do this, right? So we really need to understand that the opportunity comes from weak internal controls. Now that, of course, has a lot to do with your board of directors, because internal audit is going to be coming under the audit committee, right? And the audit committee obviously comes under the internal as well as external audit. Both of this comes under the audit committee. And when we talk about internal controls, you really need to have a very, very strong audit. So the BOD, the board of directors, are going to have an audit committee, and that audit committee is going to be looking at the internal and external audit, right? And that is the tool to make sure that we are following our standards in a proper, unbiased way. If that is not there, then the management, if the motivation arises, could go for such choices. Of course, rationalization is something that has to be done as well. So they might feel that, oh, we are being treated unfairly, we are getting very less fixed salaries, our entire compensation is based on growth in earnings. So, I mean, what can I do? I have to feed my kids, so sort of a situation. So they might then rationalize it to themselves. But whether or not the rationalization is there or not, whether or not the motivation is there or not, the whole discussion starts with weak controls, right? So we really need to understand that, okay, motivation and rationalization are something that we need to deal with as well. But the primary control, and this is where the government comes in as well, is that to make sure that the opportunity for them to do this is not there. And, all of this really ties in with what happened with the Enron scandal and the Sarbanes-Oxley Act that came after the Enron scandal, and how all of that has really changed about the way we manage our internal controls. So before, internal controls were not something the auditor had to actually evaluate. But now, after the Enron scandal and after the Sarbanes-Oxley Act, we really take internal controls a lot more seriously than we did before. So this is where the government steps in now. Right, and Sarbanes-Oxley Act, of course, is a major legal input into all of this. That what are the requirements from the auditor? Do they only have to check the financial statements, or do they really have to check the control system as well? Well, they have to check the control system. And the management is responsible for it, right? The management is responsible for it. They cannot get a clean sheet and say, oh, it's not our job, it was the auditor's job. They have to give you a discussion, management discussion and analysis. They have to talk about the control systems. They have to talk about what's going on in the business, what is expected in the future, right? They have to keep disclosing on a quarterly basis what's going on in the business, right? And of course, there is a mechanism to enforce all of this. So this is where the government steps in, and the external auditors are there, and you can even have other private parties coming in and reviewing the control system and helping you with the internal audit. So yes, this entire context is available for companies that really want to have a high quality financial reporting, but then there is still some room where there is some possible wiggling by these people. And what now you need to do is that you need to focus on how to detect if such a situation is happening. What are the warning signs you should look for, and how do you go about detecting all of this? So I think we're going to take a break here. Then we'll come back, and then we'll get into the detection of these things, and then we will also get into the more detailed discussion of how there are choices that the management can take that will affect the financial reporting. So let's take a break. We'll come back and discuss all of this.